We are trapped inside this fiat world in 1971 to now, and I think of that as a paperization of a liquidity crisis. And we had gold and silver as money for 6,000 years, and it spanned the agrarian age, the industrial age, we're in the digital age, and I think the fiat will blow up eventually. The only thing that's special about now is the whole world got rugged all at once. So, we're all sort of debasing ourselves to oblivion where, when one kingdom debased, they blew up really quick because, everyone ran to the gold-backed kingdoms.
But I think we're going higher just because you just look at the math. There's just way more demand than issued supply of Bitcoin or, existing overall supply in the marketplace. So we still maintain our price target between 180 and 200,000 by year end. And I think that's a cautious price target, by the way.
Big money is moving into crypto. Not just pushing prices higher but reshaping the future of money itself. With Bitcoin ETFs now live and backed by giants like BlackRock, institutions finally have a clear path in. The math looks explosive. Bitcoin's $2 trillion value is still tiny compared to the $900 trillion global asset pool, and with only 450 coins minted daily, demand could send prices soaring. But there's a catch. As more institutions pile in, Bitcoin faces the risk of centralization. If a handful of funds or corporations hold too much, they could become the very gatekeepers Bitcoin was built to escape. The tug-of-war between adoption and decentralization will define what comes next. Anthony Scaramucci of SkyBridge says this shift is healthy. Early whales are selling, institutions are buying, and ownership is spreading out. He believes this demand dynamic is just beginning, boldly predicting Bitcoin could surge to between $180,000 and $200,000 by year's end. Let's take a look at his interview for deeper insight.
Listen, there's been pain and euphoria in the Bitcoin markets over the last 5 years. I think what's happening now is lots of consolidation and institutional adoption. So if you went to a conference like this 3 years ago, it was mostly retail investors and CEOs working in the layer 1 blockchain space. Today, it's lots more institutional investors. So that's finally starting to happen. If you look at the numbers on something like the BlackRock ETF, the IBIT ETF, you can see now, Andrew, there's lots of institutions coming in. So what's interesting is that some of the whales have been selling. So I know I've seen your interviews with Michael Novogratz and the 80,000 Bitcoins that sold last month. And so there's a consolidation story happening. There's a change of ownership story happening. But I think we're going higher. Just because you just look at the math, there's just way more demand than issued supply of Bitcoin or, existing overall supply in the marketplace. So we still maintain our price target between 180 and 200,000 by year end. And I think that's a cautious price target, by the way. I think there are people that are way above us, those levels. But I just think it's a function of buying and only 450 Bitcoins being made by the network per day. They're all linked to Bitcoin, IBIT being the purest link to Bitcoin. I think what Michael has done is absolutely extraordinary, as evidenced by all of the copycats that are out there. And again, not just copycats for Bitcoin, but for Ethereum, Solana, Avalanche, and others. And so it's different strokes for different folks. Michael, you're probably getting a little bit more of a kick to your Bitcoin exposure. IBIT, I think it's a pure play, and I would just point out that places like JP Morgan will actually lend on IBIT, and so it's a very secure asset that people trust. I own a lot of Bitcoin and hold it in storage, Andrew, for myself and for SkyBridge. And so there's different ways to approach it. I think the institutions will likely go into the ETFs. And of course, there's a lot of institutions that, quote unquote, can't own Bitcoin, that they end up owning Michael's stock or synthetics like that. And also the state of Wyoming is announcing this morning their own stablecoin. So you can add that to the mix as well. Congratulations to the state. I just think that that's generally good. I share Secretary Besson's view of this, that's generally good for the U.S. dollar. It means more treasuries, more short-term treasuries, demand for those securities. But I also think it's going to bring a wave of technological innovation. We, at our last conference in Bermuda, we did a drop of stable coins into people's phones where they could spend, I guess it was $100 at the different tourist shops on Front Street in Bermuda, and it worked beautifully. And I think you're going to get to the point where we're transacting using stablecoins. It may bypass some of the credit card fees and some of the other ancillary third-party confirmation fees that we've charged historically in the marketplace. So I generally think it's very good. I think those companies will consolidate. And I think one of the discussions here at the Wyoming Blockchain Symposium is going to be about a central bank digital currency. And I stand with President Trump on that. I don't think we need that. I think it could be, from a libertarian perspective, too intrusive from a privacy matter. And I think the private companies are doing a great job in this area. And so I'd like to just stay in the private company realm as it relates to dollar-based stablecoins. If you look at the last legislation, there's no yield on the stablecoins, Andrew. So if you're converting dollars into a stablecoin, there's going to be a spread there for those guys naturally. I don't think the competition is going to impact that, unless we switch up that yield mechanism.
Willy Woo says Bitcoin needs institutional capital to become a true global standard, but he warns this growth may come as a Trojan horse. If the US dollar weakens, governments could step in, just like gold confiscation in the 1930s, seizing Bitcoin reserves into a digital Fort Knox and undermining its purpose. He also warns about companies copying MicroStrategy by using risky debt to buy Bitcoin. If prices fall sharply, forced liquidations could trigger a wave of selling and negative headlines, hurting Bitcoin's reputation for years.
So you can think of Bitcoin as a little Pac-Man, and we'll be eating these little dots. Gobble, gobble, gobble. Now the big cheese, you're digging into that, right? So I think the tipping point, I think it really was a tipping point, was last year when the BlackRock ETF came on board and the high priest, Larry Fink, said, we're doing this ETF and now you can talk about buying Bitcoin for the rest of the traditional world, right? That encapsulates $900 trillion of wealth assets. Bitcoin at this point is $1 trillion. And we always here talk about liberty, separation of money and state. That means that the government can't overspend and then tax everyone through dilution, effectively stealing from the poorest. That doesn't end until that Pac-Man gets big enough to displace the US dollar, flips gold and becomes a monetary standard. And that's not going to happen until you get the large gatekeepers of capital opening up to Bitcoin and pouring that money in. It's a necessary step. With it comes risks. We can talk about the fragility of centralization. If big pools of Bitcoin get stored in one location, that might get nationalized and so forth. But that's a different discussion. This is always going to happen if we're ever going to.
Cyber criminals are getting smarter, and everyday investors are the new target. You worked hard for your crypto. Don't lose it to a scam. Recently, attackers bribed offshore agents at major crypto platforms, stealing names, birth dates, even social security numbers. They drained real accounts in seconds. No blockchain hack, just human error. Once it's gone in crypto, it's gone. That's why ITrust Capital created the Premium Custody Account, the most secure way to protect your asset. It's a closed-loop system, meaning funds can only move between you and your account. Even if someone gained access, they can't steal your crypto. Backed by institutional-grade custody at no extra cost. Sleep easy knowing your investments are locked down. Click the link, use code DOSE7, and get a $100 funding bonus. Start protecting your future with ITrust Capital.
Effectively change the way the world uses, what we use as money. I don't think centralization around Coinbase and that being hacked is the danger. I think it's really the nationalization path, which happened with gold, and it's happened before. And if the US dollar is structurally getting weak and China's coming in, I think it's a fair point that the US might do, an offer to all the treasury companies, incentivize that. It could be then put into a digital Fort Knox, create a new, gold standard. You could then rug it like happened in 1971. It's all centralized around this digital Bitcoin. The whole history repeats again and back to fiat again. And then now we're in this position where we tried this Bitcoin thing, but that didn't work, so it makes the second attempt harder. I think that is the centralization risk when it comes to a very big and powerful nation state.
So do you think it's more probable, it's more probable that the US may acquire an existing company with a lot of Bitcoin in treasury rather than holding their own treasury?
Yeah, I think that if you were like, say you wanted to get, say, 4% of the, 4 million of the Bitcoins, you're going to buy it on the open market and drive the price to infinity, and Michael Saylor becomes probably the richest person alive, and therefore, well, let's say most powerful person alive because it's common stock held. Or are you just going to like do a share offer and effectively nationalize in a very free market fair way? You've got this big bag of X million by then Bitcoin. You haven't run up the price, and then everyone who's just sold their MicroStrategy stock, let's say, now has to buy back their Bitcoins, and then it runs up. I think that would be the smarter way to do it. But just thinking about the dynamics of how would you get a big bag of Bitcoin and then create dollars trading off it, or backed by it, and then how do you rug that into fiat? I think that's a path that's been done before. Strategy is probably the most robust of these companies, and you see in this cycle everyone's following the model, but it's not the exact model. And we have to be careful of the risks that are being taken. Strategy, originally when they were doing the convertible debt, was I think it was a 5-year out debt. And so, I think MicroStrategy might have been close to liquidation in the last bear market had the debt not been pushed out 5 years. So I see a lot of these companies now have quite short-dated debt using the older model of convertibles, where Strategy went to 8 to 12 years, and now they're doing the preferred stock. You look at Metaplanet, and they're doing this sort of hedge fund play where there's a hedge fund. They're doing a back and forth to simulate a at-the-market offering, to effectively simulate the ATMs that MicroStrategy are doing, but they're taking big tranches of debt, 300 million at a time, and then selling that into the market to replenish, to then pay off the debt. If the market turns on that at the wrong time and they cannot do this market operation, you're going to get liquidated. And it's not 4-year debt, it's not 8-year debt, it's immediate debt. And so you really need to look at the copycats and look at the dangers in the debt structuring and the liquidation risk. And my opinion of Metaplanet is that they are quite expert at timing the market. Maybe that's the game that they played. They absolutely bought the bottom wick of the last major dip and unloaded almost 300 million in that one buy. So maybe they're proving they can time the market, but that's what you're buying. You're buying a treasury that has opted to time the market, and they think they can unwind the debt at the top from the looks of how they've structured things. And, there's a lot of these treasury companies, a lot of paperwork to work through. You want to know what you're buying. There's risks in it. MicroStrategy is the blue chip. Very, very robust. Still risks, obviously, with everything. My concern is the copycats that aren't doing it at the same level or have, how many of these guys can offer preferred stock? What are their options? A lot of the latest vogue is to really start small and run up the leverage, get the yield right up and grow fast. We're tail end of a bull market right now. So I think a lot of people are going to get hurt, and we'll have massive MNAV compression. We're going to have liquidations of some of the weakest treasury companies, and we'll see who's going to survive and what's going to break over the next bear market. And I'm wondering about what the commentary from TradFi will be as I look at those Bitcoin or crypto people, look what they did there and look what broke, and another cycle of jokes on us. We are trapped inside this fiat world in 1971 to now, and I think of that as a paperization of a liquidity crisis. And we had gold and silver as money for 6,000 years, and it spanned the agrarian age, the industrial age, we're in the digital age, and I think the fiat will blow up eventually. The only thing that's special about now is the whole world got rugged all at once. So, we're all sort of debasing ourselves to oblivion where, when one kingdom debased, they blew up really quick because, everyone ran to the gold-backed kingdoms. So this will blow up. And then what replaces gold? And it's not going to be gold again, because you can't get, it's no longer scarce. Not in 100 years, not 1,000 years. I mean, gosh, who knows what technology we'll have then? And it's only a few decades away to mine asteroids, given the pace of that technology. So you have to secure the scarcity, the ledger, with something that grows with technology, and that's energy. And Bitcoin's had the 5% adoption. It's very hard to catch something like that. For money, there's only two properties of money. One is it's accepted, and number two, it's secure and robust. And that was the scarcity element of gold. And all the other stuff was just people thinking about gold. It should be divisible. It should be, durable. And that was us using atoms to secure the ledger. But that doesn't apply anymore. And so you pan this forward 1,000 years of technology, it's got to be an energy coin, and we've got one. And it's reached, hundreds of millions of people already, soon to be 1 billion. Well, I think it's ironic because the banks shut down banking for the exchanges back in the early days in 2013, 14, roughly when Tether came to be, because there was no banking to be had. So they were the de facto banking, and they got so big that they're now on track to displace China's buying of treasuries when Bitcoin hits $1 million. And therefore, the US government becomes dependent on Bitcoin. Because how it works is there's an order book on the exchange. You've got Bitcoin on one side, you've got US dollars on the other side, but it wasn't US dollars, it was Tether. So as the liquidity increases, there's more and more expansion of Tether to trade for it. And now, it's at the point where it's displacing the largest nation states to buy the US treasuries.
Anthony Scaramucci and Willy Woo paint two very different pictures of Bitcoin's future. Scaramucci is highly bullish, pointing to institutional demand through ETFs as a fundamental game changer. With only 450 new Bitcoins mined daily against massive appetite from big funds, he believes the supply and demand math is undeniable, predicting prices could reach between $180,000 and $200,000. He even sees recent whale selling as a healthy consolidation that strengthens Bitcoin's long-term foundation. On the other side, Willy Woo agrees Bitcoin's potential is enormous but warns that the way institutions are entering could be a Trojan horse. If too much Bitcoin ends up concentrated in ETFs, custodians, or corporate treasuries, it risks recreating the same centralized vulnerabilities Bitcoin was built to escape. Woo even raises the possibility of governments stepping in, like in the 1930s with gold confiscation, and seizing large amounts of Bitcoin to maintain control. Together, their views highlight both the opportunity and danger of this moment. Institutions bring legitimacy and capital that can drive Bitcoin higher, but they also threaten its core principle, decentralization. The ultimate safeguard remains self-custody. If Bitcoin holders chase rising prices without securing their coins, the ecosystem could win the adoption battle but lose the war for independence. Do you think institutional adoption will strengthen Bitcoin or weaken its true purpose? And when it comes to ownership, do you prefer the convenience of ETFs or the security of holding your own keys? Let me know in the comments. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.